All right, so if you're new to real estate investing and we're trying to figure out how much money are we making, what is our percent money that we're making each year, and how can we compare different assets? How do we compare house A versus house B and see which one is a better deal or which one is going to make us more money each year? So we have two tools that kind of help us see how to do this. The first one is called cap rate, and that's calculated on the year. The next one is your cash on cash ROI, or return on investment. Again, I'm going to make a PDF with all these different acronyms and what they mean and how they help you navigate all these different stuff. This one's also yearly. So what is cap rate? Cap rate is when you take the NOI, your net operating income, and divide it by the purchase price. This works easiest when it's not leveraged, when you pay all cash. You can calculate it with a loan, but it just gets a little bit more confusing, and I have spreadsheets that show it, but it's hard to do by hand. So on our previous example, we said that our rent was $1,500, and we're going to ignore this loan line here. And then we have all of our expenses at $700. That's going to leave us with $800 a month in NOI because we paid cash, we have no loan. That's being $9,600 a year. We're going to have a pretend property worth $160,000. So we're going to take the NOI, $9,600, put it over the purchase price, $160,000. Here we go, do some quick math. It's going to be 6%. Generally speaking, a not leveraged cap rate of 6% is pretty favorable. That's a good investment. Above 6%, 7, 8, 9, 10, that's an excellent investment. Below 6, you're running it really close and you're being a little bit more risky. So generally 6 is kind of a threshold that is usually pretty attainable. The next tool we have is cash on cash ROI, return on investment. This is also calculated on a yearly calculation. What we do is we figure out, well, how much cash are we getting back on the year versus how much cash we put in the deal. So it's cash on cash. This usually works with down payments, repairs, things like that. How much is all your cash in versus how much you're getting out? In this $160,000 house, if we get a loan with 10% down, we put $16,000 into the deal. If we come back to here, if that $16,000 was able to get us a $600 payment, for example, it really be 600 plus 400, so it'd be $1,000 loan payment, for example. That gives us our NOI of $200. $200 is $2,400 a year. Take $2,400 over the $16,000 that we put in, it gives us a 15% cash on cash ROI per year. So this is how we break down to compare two different investments and how they perform.